Hi, let's talk about Curve, ticker symbol CRV, currently at $2.72, market rank 87 with a market cap of 1.1 billion. Now this video will be a bit different to usual. Usually on this channel what we're doing is we're simply checking charts, we're looking at US dollar charts, we're looking at the relative performance to Ethereum, trying to find chart patterns, trying to find potential support and resistance lines. But in this video, we're going to talk about the product, about the decentralized app, about Curve. We will talk about how Curve works, how to get yield on your crypto, and how to actually read those different numbers here. What do those liquidity pools here mean? And I will also show you my favorite liquidity tool within Curve, so where I personally think is the best risk versus reward at the moment. Now, first things first, Curve works the following. Curve Finance, the link is curve.fi, is basically a DEX similar to Uniswap. So you can log in with your MetaMask wallet and you can switch assets. Curve started out only with the stablecoin, so you could switch, for example, Tether to USDC, and then you have a pretty low slippage. So you can exchange those stablecoins almost one-to-one. The point here is almost, because Curve is a automated market maker. It works differently to, say, Binance, where you've got an order book, right, where you directly trade with other people. In Curve, when you do such a swap, you're doing the swap against a liquidity pool. And so there's a small fee that Curve keeps, a small fee for executing the swap, and the proceeds of that go to the liquidity providers, to the people that put money into the pool. And so the way this looks like is when you put your money in one of those pools, then you get a base return, which will be in one of those assets. And on top of that, you get an additional return here in CRV tokens. There's a range for these CRV returns, which depend on the way how you stake the tokens. Now there's quite a bit of complexity here, but I try to break this down as easily as possible. So there's different versions of Curve. You can see here, you can select between the different networks. The standard Curve, the curve.fi, runs on the Ethereum blockchain. Now you need to note that the Ethereum blockchain has pretty high gas fees, which makes earning these rewards only worthwhile if you're depositing quite a bit of Ethereum. So let's make an example. Let's go here to the largest of the pools. We click into the pool. And now we get a different navigation over here that's related to this pool. We can only swap the assets within the pool. But what we're really interested in is making a yield, right? So we click on deposit and now you can deposit your crypto into this pool in order to gain the return, right? The 2.5% per annum on whatever you deposit. You can either deposit Tether or wrapped Bitcoin or wrapped Ethereum, whatever you like. And on top of that, the CRV return. So let's say you just want to try this out and you use a test wallet and maybe you want to deposit half an Ethereum. Now this is where the gas fees come into play. If you deposit this, your MetaMask wallet will open up. And what you will see is that this transaction here will cost you in gas fees $140 US. So you have to pay 140 or now it's 130 US dollars just to put money into the pool. You have to pay the same to get the money out again. So the way this works technically is this is obviously an Ethereum blockchain transaction. You exchange your Ethereum here for a token on Curve, for a Curve token that's related to this pool. And this Curve token will then increase in value over time. And then afterwards, you can decide at any point in time to withdraw this again and exchange this for any of those currencies that the pool owns. So you can pull out again your wrapped Bitcoin or your USDT, whatever you want to pull out of the pool once you want to get access to your money again from that pool. Now this is pretty high, right? And so think about it. How much would you actually have to deposit in order to make this a worthwhile endeavor? Say you've got $250 transaction fee, so $125 for putting it in, $125 for putting it out, and you don't want to lose more than, say, 1% of yield to those transaction fees. That would mean you would have to deposit at least 25,000 US dollars for such a transaction. So at the current Ethereum price, that would be 7 ETH. So if you hold it for 1 year, you would then get an effective return of 1.56% plus the CRV tokens. So say you halve that, you only deposit 3.5 Ethereum, then your base annual percentage yield is almost completely gone. So those are the sizes you deal with when depositing here on the standard Ethereum-based curve. And so I don't think this is the best way to go about this. There are different networks over here. And so I've looked at all the pools of all those networks to give you my perspective of what makes sense and what doesn't. So let's start with the very first one, Arbitrum. So you're now dealing with a new blockchain. You're not dealing with the Ethereum blockchain. So you gotta switch networks within your MetaMask wallet. And here are basically two pools that have some kind of a size. I think the small ones can be pretty much forgotten. One of them dealing in Tether and in wrapped Bitcoin and wrapped Ethereum, and one of them dealing in magic internet money. Now, I personally don't know enough about the risk of magic internet money. It's basically a borrowing and lending platform. This is supposed to be a stable coin. The pool itself is also permissionless, so it just has been added by somebody. It hasn't been vetted by Curve. So the yield here is very high, but I personally don't know enough about it to recommend this to anybody. But I think this could probably be too risky. And that's also because of a second point. That's not necessarily because of the stablecoin, but also because of the CRV token included in this pool. So what you see is that these pools, they're made up of different underlying assets, right? So here the stablecoin and here CRV. For the other large pool here in Arbitrum, we see USDT, wrapped Bitcoin, wrapped Ethereum. Now let's start with USDT. You are basically exposed to the risk of all three of those underlying assets when you stake in the pool. Because the way it works is people that use Curve for swapping their tokens, they swap their tokens against the pool. And let's say something terrible now happens with Tether. And the price peg of Tether to the US dollar vanishes, right? USDT falls in price and is not anymore $1. Now what then happens is that people will swap their USDT for your wrapped Bitcoin and wrapped Ethereum, and you suddenly have a lot of USDT in your pool that's worth less compared to the wrapped Bitcoin and wrapped Ethereum you had before. So if one of those assets completely implodes, you will lose your money here. So you need to think about it. Does it make sense for you to basically be exposed to Tether for a return of 22% per year that's paid out in CRV tokens? So that's one problem, right? How stable is the stable coin? The second problem is the wrapping of tokens that fluctuate in price, because there something comes in called impermanent loss. When you stake a fluctuating asset in a pool, you are betting on the asset to stay stable in price somewhat. When one of the assets moves too much, say it doubles in price, then you lose money. And that's because the prices on the liquidity pool, they adjust according to demand, right? To demand and supply. And say when Bitcoin suddenly shoots up 100% in value, then the liquidity pool will not yet have noticed that. It will sell the Bitcoin for a lower price, and then more and more Bitcoin gets bought up from the pool, and then the AMM algorithm will adjust the price, will put it higher and higher. This goes exponentially actually until the trader that's trying to buy up the cheap Bitcoin within your pool doesn't have a profit there anymore. But that's basically the effect. There's a lag in finding the price within the liquidity pool. And so when there's too much movement of an asset in a certain direction, when there's too much volatility going on, then you will experience a loss. You really want your underlying assets to be stable. And that's why when you see the return over here, you have a way higher return for the pools that include Bitcoin and Ethereum compared to the pools that only include stable coins, for example. That's a pattern you will always find on Curve. Whenever there is an asset in here that potentially fluctuates in price, your return here will be higher. Now, is this a good return for the potential risk? You can look at this the following way, right? 22%. Do you think that one of the assets might move by 4x within a year? That's the first question. So that's the potential risk you're taking, right? Say in 1 year, something like 150% in relative movement between Ethereum and Bitcoin can potentially happen. So you will lose that money. And on top of that, you get this return in CRV tokens. And historically speaking, the CRV return versus Ethereum hasn't been too great, right? This is a 95% underperformance. Recently, we are kind of like in a sideways trading range, but still I wouldn't give this 100% of the APY because probably the value, at least versus other cryptocurrencies, is likely to decrease. And that's also because the utility of the CRV token. To my knowledge, the CRV token does nothing else but governance for this decentralized application. There's no other utility. There's no utility as in reduced swap fees or anything like this. You're really just voting on governance questions. And so I can see a lot of people that earn this reward selling the CRV tokens after a while, simply to then use that money elsewhere. So I didn't find any interesting pools here on Arbitrum. On Avalanche, we can make 24% basically, 3% on the stable coins, 21% in wrapped AVAX. We again buy in the risk of having Tether in here. And so if we look at other chains, this kind of profile we see relatively often. So just stable coins with Tether. Let's compare those. So here we've got 3 plus 21. On DAI, a similar pool, we get basically 0 plus 21. But here paid out in CRV. And so the question is, do you want to get your payout in AVAX or do you want to get your payout in CRV? Now this is the historical performance of AVAX versus Ethereum. This is the historical performance of CRV versus Ethereum. Or this is the relative performance of AVAX to CRV. So AVAX outperformed CRV in this time frame a bit over a year by 3x. So if you ask me what's the better pool, I'd probably prefer the payout in AVAX. Same risk profile, stablecoin plus Tether, 21% return here, 21 plus 3% here. So I wouldn't see the reason why you would take the DAI blockchain over here, why you would take this pool. So that's why I think we can eliminate this. Next, we've got Harmony, very similar risk profile. And I think this is actually the best. This is even better than the deal we get here on AVAX. AVAX is 3 plus 21. Harmony is 12 plus 10. The 12% is directly on the stablecoin. But on top of that, we get the wrapped 1 token. And if you look at 1 versus Ethereum, that's the long-term chart here. This is 1 versus AVAX, so also an outperformance, 266% in around 1.5 years. So of course, we never really know if these trends, they will continue, right? But very often these trends have to do with tokenomics, with token issuance, with utility. And so if the risks you want to take is stablecoin plus USDT without any impermanent loss problems, then probably this pool here on Harmony makes a lot of sense, simply because the AVAX token might again decrease in value over time. Now there's a very similar proposition here on the Polygon network, USDT together with other 2 stablecoins. It returns way less though, right? 3.7% on the base, 7% in CRV and 4% in Matic. Matic's relative performance to Ethereum, by the way, was pretty good. Now recently it's bleeding, but over the long term it's increasing. So I'll probably see this as a neutral performance, right? I wouldn't take at least a lot of discount for the Matic return. But this again, let's say we discount the CRV return, maybe cut it in half. We have 4% plus 3.5% plus another 3.5%. So that's 11% we get here for this stablecoin bet with Tether. And if you compare this to Harmony, that's way better, right? We get 12% simply as a base. So if that's your risk profile, you want to take the Tether risk, I would go with this pool. Now, what about if you want to take impermanent loss risk, or if you want to invest into stables but without Tether? Say you want to take the impermanent loss risk. This pool over here on the Polygon network looks very nice, right? 3.3% on the base, 12% in CRV, so let's say that's 6%, and then an additional 13.4 in Matic tokens. Now, where does the Matic return come from? That's basically a subsidy from the Polygon network. The Polygon Matic project is giving out tokens for people using their platform. That's where this is coming from. The base return and the CRV return come directly from the decentralized exchange, right? They directly come from swapping the 13.4%, not necessarily. This is unique to the Matic blockchain. You only get this by using Polygon. We do have one alternative to this though, which is also interesting. And that's this pool over here. Same risk profile, Tether plus impermanent loss from Bitcoin and Ethereum. Here in Phantom, Tether plus impermanent loss from Bitcoin and Ethereum. Here giving 7% in CRV and 26% in wrapped Phantom. And Phantom did pretty well versus Ethereum. This is the long-term Phantom chart. So I would definitely not discount the return from Phantom. If you think that Phantom will continue to rise while Bitcoin and Ethereum will stay more or less stable, then this is the pool to deploy capital in. Now, I'm personally not really a fan of the impermanent loss risk. It gives way more return, but it has quite a bit of risk. So out of all those pools, my personal favorite is this one. DAI, USDC, not giving a lot of base APY, giving only a little bit of exposure to CRV, 2% return, but giving 12.5% in Phantom. So you have watched now all the way through for this video. To get my personal favorite, that's the one. No tether risk, no impermanent loss risk, just stable coins. And we get 12%, more than 12% per year paid out in a token that historically outperformed Ethereum. That's, I think, the one that makes most sense. I took quite a while to compare all of those pools. It was quite a bit of work. But in the end, I came to the conclusion that this is probably the best. So what happens is you put in, say, 1,000 US, and after 1 year, you will get Phantom tokens worth 120 US. Plus, on top of that, $23 US worth of CRV. And of course, last but not least, you also get a little bit of DAI or USDC to compensate maybe for transaction costs when you don't yet have any DAI or USDC when you swap this beforehand. Now, in order to invest in this, you have to bridge your DAI or USDC to the Phantom network, right? So there's a bit of a process here involved. I haven't yet done this myself, but if you're interested in such a video, I'm probably going to deploy money into this pool. If you're interested in a how-to video, let me know in the comments down below, and I will record my process of deploying capital into the 2 pool on Phantom. If you enjoyed this video, please give this a like. YouTube will then help to grow the channel. And if you haven't yet, feel free to subscribe as well. I publish videos regularly. Last but not least, we've got a Telegram channel. We are almost 800 people over there, the Bitcoin Strategy channel. You can join us either by clicking the link in the video description or by searching for Bitcoin Strategy channel within the Telegram app. See you next time. Bye-bye.